have you seen any pattern evolve over the years in terms of investor behavior, in terms of people accessing your research?
Anybody who has come in the market and invested in a mutual fund or shares in the last 5 years, those people, they're still chasing performance. They chase things, what looks attractive, what has done very well in recent past.
When PSUs ran mutual funds, share certificates moved by hand and ATMs were just arriving. He was already decoding how India's investing ecosystem was going to take shape through value research. This is Dhirendra Kumar on MF Chronicles.
When I'm thinking of, for most people, times take care of everything. I really remember, one person who recently visited me that, he has inherited these 20 shares from his father. And of those 20 companies, stock portfolio, he had 18 companies which were almost worthless. 5-7 companies were of some nominal value. 8-10 companies did not exist. They don't trade anymore. And he had that 2-3 companies which have been held for these 20 years, that actually he was a multimillionaire as a result of it.
Do you find any predictable trend, or do you find any insight between male and female investors?
The bigger divide is not gender. The bigger divide is geography. The second-tier city which has less access, they are more aspirational. They are more venturesome.
This is an industry today where people look at it and say, not only can we have our dreams fulfilled, but from the outside, and indeed it is, this industry is the stuff dreams are made of. Welcome to another episode of MF Chronicles. Let me start by telling you a small story. This is a story about the Indian investor not so long ago. He used to invest on the basis of tips, narratives, and urban legends. Well-meaning advice coming in from different quarters almost seemed like Chinese whispers. But unintentionally, they were investing into mutual funds without even realizing it. Just because किसी ने बोल दिया कि आप ये म्यूचुअल फंड में लगा दो या वो म्यूचुअल फंड में लगा दो तो लगा दिया. एक्सपेंस रेशियो क्या है, पोर्टफोलियो क्या है, लॉन्ग टर्म के लिए है कि शॉर्ट टर्म के लिए है, ओपन एंड है, क्लोज एंड है, पोर्टफोलियो क्या है, कुछ खबर नहीं. And as one thing led to another, people simply stopped asking where they were investing. In fact, इस कहानी में एक और कहानी है. इस कहानी में एक twist है. My guest today was telling me about an interesting anecdote. There was a scheme in around 1990 which was called the Magnum Multiplier scheme. Closed-end scheme, NAV of 10 rupees, but market price of 20 rupees. And during the Harshad Mehta scam, it went up substantially, almost 10 times that. And of course, the smart guy that he was, he invested his family's money and disinvested at the right time. But it led him to question, how come the value shot up from 10 or 20 rupees to 160 rupees and then just collapsed after that? When he started digging into it, he realized that this is now leading to a higher calling. I'm talking about this young, lanky lad who came in from Patna in Bihar to Delhi to study and stumbled into the real world of investments. Actually, I shouldn't be saying stumbled into. He got into the world of investments and created a revolution called value research. He's a friend. He's an industry colleague. We've been on several panel discussions together. We agree to disagree most of the time. He's focused. He's forthright. He pulls no punches when it comes to saying his mind. And indeed, I would argue that he's one of the top 50 voices in the mutual fund industry, which has shaped the narrative of this industry for the last so many years. It's indeed a pleasure to welcome Mr. Dhirendra Kumar on our show. So, you were just telling me about this anecdote of MMS 90, Magnum Multiplier scheme. It just took me back memory lane. And I remember one of the, should I use the word fancy stock? Because that was the way it was going up at that point of time. Just take us through, what actually started off there and what motivated you to invest, disinvest, and this higher calling which led to this.
I would not say, this fanciful thing called higher calling, but yes, it was an experience. It triggered. It was entirely based in curiosity. And looking back, I can understand the context. And let me just take you back a little bit more than 1990. What happened was I came for my graduation to Delhi in 1987. And I became curious about finances, markets, and Delhi gave me an opportunity to read about financial, investment books, the Bombay Stock Exchange directory, or whatever the basic information, Economic Times every day, fresh from the press, then waiting with a air surcharge in a second-tier city where you get next day, things like that. So I was more aware of, I became aware of how things work, but we were still a regulated economy. So being in capital of the country, I had access to information. I became curious. And then I realized that there are mutual funds. And then I got a sense that people should invest in equities. And investing in equity for common people, people should invest in equity for the long term. That is the best way for people to optimize their return. And mutual fund came in very handy because it was not possible for individuals to invest in stocks directly. If you had 5,000 rupees in fact, 5,000 rupees used to be a very big sum. If you have 1,000 rupees, 2,000 rupees, then no broker will be interested in entertaining you. They will not let you into their office because stock trading or, enabling transaction was a very risky thing. Market was physical. You had share certificates. You signed a transfer deed. The signature must match in the company's record, and you sent to the company those physical things. There was no dematerialized market. So the role of mutual fund when it started, though mutual fund is very old in India with Unit 64 and it started in 1964 theoretically. But till 1986, the mutual fund story is that it was only quasi-fixed income, quasi-debt. All the schemes of UTI were promising return.
Guaranteed return.
Guaranteed return. So it was considered as, another vehicle, another savings vehicle which guarantees return, which used to invest in companies and primarily lend money to companies. It was almost like a developmental financial institution, and equity ownership of UTI in that period, 1964 to 86, was primarily by conversion clauses. If a company will default with its lending, UTI, somebody needs money, want to set up a factory, it will come to UTI. And it will invest, UTI will lend money. And once in a while, as it happens, you will default. And they had their lending contracts, the caveats were that if you default, we will convert our debt into equity.
Oh,
that is how they became the owner of a large equity ownership.
Interesting.
So that was the life of UTI. And some of those schemes carried on, the MIP and the Rising Income Scheme and all that. So I was very curious about it, but it had nothing in it for the investor. If UTI was becoming richer by owning those equities, by those conversion clauses, it became the owner, and that is what the UTI corpus was. But 1986 was a turning point. 1986, the government allowed public sector banks to sponsor mutual funds.
Okay, that was 1986.
1986.
Interesting.
And that is when Master Share was also started. Master Share started as an all equity fund.
The first
equity closed-end equity fund in the country.
The first openly talked about closed-end equity fund. It was not.
It was not guaranteeing return. You invest in that, and it will be a diversified portfolio of stocks.
Very interesting.
So 86 was the starting of a diversified equity fund with Master Share, and public sector banks were allowed to operate their mutual fund, and every mutual fund by public sector banks started as a division of the bank. So SBI Mutual Fund started as a division of the bank. So was Can Bank. And they all operated in their investment banking. So SBI Cap sponsored SBI Mutual Fund, or maybe they had some kind of operating connections. Likewise Can Bank, likewise Indian Bank, likewise PNB, likewise GIC. So we had these 8 companies, Bank of India and Bank of Indian Bank and PNB and Indian Bank. So in all, there were 8 public sector companies till the sector was open for private participation in 1992. So till 92, these 8 companies operated, and from 86, the equity fund started. And the first few, MasterShare wasn't a blockbuster. What was blockbuster was what followed after that. There were two schemes of Can Bank mutual fund, which were absolute stunner. Can Bank started with a fund called closed-end fund like MasterShare called Can Share, and this fund became 3 times its value in 5 years' time, the NAV, and it was a small fund. And I remember the first CEO of that Can Bank fund, and the way he was managing it. And the market was Wild West. You can just buy 10 stocks, and if you corner it, the whole thing can be, because they were the only institutional participant in the market. Everybody else was an individual.
Correct.
And everybody else was, if not an individual, was an operator. And they were the only institutional players. So Mr. Dharampal used to run those funds, and they in fact, the initial 2-3 year returns of this was so high, so strong performance, and in 5 years time or 3 years time, they redeemed the fund and the money became 5 times, and there was no supply of these closed-end funds. What happened was Can Share, then another fund followed called Can Growth.
Can Growth, I remember, yes.
And MasterShare. So these were the only 3 funds available for Indian investors. And the charm of these investors was that Indian stockbrokers were not entertaining investors to invest in stocks. The only way people could invest was, this was a new vehicle which was coming. It was demonstrated by these 2-3 vehicles that your money has a chance. And then that was now catalyzed by the great Indian scam of 1992, the Harshad Mehta scam. So all these things combined together create an unusual cocktail of optimism, chasing recent past performance, money becoming, multiplying in a hurry. And that is when 1992, in the month of May, at the peak of the great Indian scam, Mastergain was launched.
Of course, yeah.
And that was the beginning of, that was catching every Indian's imagination. What happened was Mastergain, and people had these 3 experiences, MMS 90. Before that, 5 months before, another UTI scheme was able to raise 1,000 crore in Master Plus.
Master Plus?
These were the real 5-7 milestones. And everybody thought that they have missed the bus. And then when Mastergain came, everybody thought that, okay, now this is it. They have to latch onto this. They can't afford to miss this anymore. And 1 out of every 20 Indians at that point invested in Mastergain. 65 lakh Indians when India was, about 70, 80 crore.
1 in 20, when the 5% of the Indians invest?
Yeah, 1 out of every 20 Indians invested in that fund. The money that was raised was something like 6,500 crore. Assuming that 6,500 crore, when the market was something like at around 3,000 points. If you multiply it with, assuming market is at 60,000 on Sensex, forget about, assuming that the downside. Imagine this amount and multiply it with the, it will be 1,30,000 crore, 1,30,000 crore NFO mobilization. It is this kind of number we are talking about in that context. So MasterShare was a turning point, and then the private sector mutual funds started, and then Morgan Stanley was able to demonstrate, and that was the time when we were still an economy which were trying to grapple with the changed reality. People used to think that anything foreigner must be good. People used to buy the Ray-Ban glasses with the same expectation that everything foreign used to be magical, because normally in a sheltered economy things were produced which were shabby, and so everybody thought that if the foreigner is coming, then he must be good, and that is why it rubbed on to Morgan Stanley as well.
Why this is a fascinating, and why I'm listening to you so intently, is because one has seen the collections in Mastergain, one has seen what happened when it played out. But I always wondered what led to that frenzy. You've just given a brilliant backstory to that.
Yeah, because you have to really understand that why people were crazy about it at that point.
Brilliant. Since you talked about investors, and since you talked about how this whole thing started in terms of this frenzy at that point of time. Over the years, you would have had millions of investors referring to your research. What would be the subscriber base of Value Research right now,
Uh,
give or take?
we deal with about, on an annual basis, we have about 10 million people who connect with us.
10 million people.
10 million people who connect with us directly through our product and Value Research Online. But I think we will have a far wider reach through our syndication in other newspapers, like my column in ET Wealth, or many online things, or something like Mint column will be reaching out, or the Jagran column. There's a column which appears in Dainik Jagran or Telegraph or Sakshi newspaper. So we have a much wider pan-India reach through for our opinion.
No, the reason why I asked you this is because if you're talking about the investor, have you seen, and I'm not talking about the investor, we talked a bit about the industry, have you seen any pattern evolve over the years, in terms of investor behavior, in terms of people accessing your research, in terms of what they do, where do they go first? Fascinating to hear if you have any trend which you would have witnessed over the last so many years that you've been providing information to the industry.
Yeah, there is a very fascinating thing, because we also have a lot of people, nearly 2 million people maintain their portfolios on Value Research Online, of which about 5 lakh people will be authenticated. They are putting their cash statement, or they're getting it from MF Central, or they're putting their NSDL cash statement every month. If you are a stock investor or if you're a mutual fund investor, you get a authenticated an official statement of aggregate of your mutual fund and stock investments. So based on that, I can tell you that most new investors who are relatively new, and by relatively new, I mean anybody who has come in the market and invested in a mutual fund or shares in the last 5 years, I would call them new.
In the last 5 years.
In last 5 years. Those people, they're still chasing performance. That has not changed much. New investors start like this. They chase things what looks attractive, what has done very well in recent past. But the good part is that I'm coming across large number of old investors, and the difference is that the scale of those relatively older investors is that if anybody has stuck around for 5 years and more, they are looking more sensible investors, and this is based on authentic data. Their portfolios that we see on Value Research Online on an aggregate basis, which is choosing good funds we do well over a cycle of market, over a full market cycle, being into relatively more diversified portfolio, getting into tactical things or something which has, they also get attracted to, they also get greedy, so to say, or they get attracted to something which has done very well, but participating in that in a very measured way. So and that is a function, and they don't panic on the first decline. So this is the behavioral thing with,
and that is the old investor who doesn't.
This is the old investor whom I would
years.
classify that who are more than 5 years old.
Very nice. Yeah, very nice. This is very interesting because and that's one of the fascinating things about seeing
but
data.
I will tell you, that mutual funds have become safer, cheaper, transparent, but most investor outcomes are still decided less by funds, more by their own behavior.
In fact, that's what I wanted to ask you. If today I'm an investor, and it's a very hypothetical question, and I have put my portfolio onto Value Research, obviously I'll be able to see basis your star ratings, where I'm lacking and where I'm not lacking, right? Do people actually go and then change their allocation to different funds basis your star rating or whatever they read on your site? Because, and I'll tell you the real underlying question is, a lot of people come to me and talk to me and say, I invested in this fund, this fund, this fund, this fund, this fund, right? And nice, good names. None of them are names which you would be embarrassed about. I asked them a question, have you seen the underlying portfolio? डाइवर्सिफाइड इक्विटी फंड में काफी ओवरलैप है. थोड़ी देर पहले आप मुझे बता रहे थे कि कितने स्टॉक्स यूनिवर्स म्यूचुअल फंड मैनेज करता है उन्होंने. So people, do they realize that by virtue of investing in 5 different diversified equity funds, I'm actually accessing the same portfolio and I need to probably have 1 or 2? Does this lead to a change in behavior once they start accessing your site? Some sort of information assimilation at their end?
It's beginning to.
It's beginning to.
Earlier, there is a life of an investor, and if he is able to stuck around, one is that when I look at all other investment alternatives, whether it be ULIP, whether it be stock investor, whether it be a speculator or a punter who starts like that, these are the ways in which people get excited about market and participate. When I look at all these ways, and mutual funds, and even in mutual funds, somebody who sets up his SIP or starts with a NFO, he buys into a fancy story, whether it be buying a e-com fund or infrastructure fund or technology fund or internet opportunity fund, or it happens. It's a fashionable thing, and all these things, or investing in an IPO. In the whole of 90s, we had this situation, and in most of these, I think I've come across people who invested in IPO, and they invested in 20 companies. And of the
IPO of a company, not
IPO of a company.
So mutual fund will call it NFO, obviously.
Yeah. That also we had to come with a law to, after 20 years, to say that let us not call it IPO, because
I remember.
So Mr. Damodaran thought that people are getting swayed by this 10 rupee anchorage. So that was a different story. But when I'm thinking of, for most people, times take care of everything. I really remember one person who recently called, who recently visited me, that he has inherited these 20 shares from his father, and it is all in his, will be transferred in his name, will be dematerialized. And of those 20 companies stock portfolio, he had 18 companies which were almost worthless. 5-7 companies were of some nominal value. 8-10 companies did not exist. They don't trade anymore. And here the 2-3 companies which have been held for these 20 years, that actually became, he was a multimillionaire as a result of it. So equity, and so I was just thinking about it, that if you end up with 200 shares of HDFC Bank, it just might be worth 50 lakh rupees if you have held it for 32 years. Because you would have got bonus, you would have got the splits, you would have got the dividends. And he will also be entitled for all the unclaimed dividend that has not been achieved. Because for many of these investors, so that is one. Second is, think of this Mastergain. What started as Mastergain, then became something else, and now it is called UTI Large Cap Fund. And it started as a closed-end fund. It transformed into something else, and on its at the end of its term, it was converted into an open-end fund. In those days, there were no direct plans. All the funds had a default. Most mutual funds, you choose to get dividend from them, and the default plan is growth plan. In case of UTI fund, all the original investors, the default plan was dividend plan, and they had to, only after open ending, investors can choose that, okay, they don't want the dividend, because dividend in mutual fund don't mean anything in case of open end fund. But in case of a closed end fund, it was a material thing, that periodically you get something and feel happy about it. Though there is a very direct proportionate reduction in NAV in case of mutual fund.
Absolutely.
So when I look at even those returns, if somebody had Mastergain, and if he has accidentally lost the certificate, and if he goes and converts it, he will be a wealthy guy if he would have invested, and your father would have invested 10,000 rupees in Mastergain. So time has taken care of everything. Likewise, in case of these funds, but people are becoming more methodical. Some of these investors who have been through a full market cycle, over 5-year-old, and maybe my follower is a very mature follower. He's asking nasty questions. He is getting satisfied. I would say he's more of an enlightened investor. He's a person who is asking that, why is he diversifying? Has he chosen 4 diversified equity fund? Is it a multi-cap fund or is it a flexi-cap fund? If that flexi-cap fund, because of its own compulsion, has become a large-cap fund, what is the other choice he has? if a good part of his investment at Value Research Online, what happens is if you put your 10 funds or you just go and put your PAN number, put your OTP, which you get from MS Central, all your historic investments will be captured, will be fetched. Initially, it was a very difficult thing to aggregate all your investments at one place.
Yeah.
So today, or if you just put your PAN number, and the account aggregator mechanism is able to fetch all your stock portfolio. As a result of this, how much of your exposure, how diversified are you? And we are able to give you a pointer that is it a meaningful diversification, or is it are you an investor or are you a collector? Because most people don't invest. They end up as a result of everything that is happening. They get attracted to the noise, the stories, the narratives, and they become a collector. Mutual fund investments or market-linked investments should not be looked like a art. Art you can collect, investments you need focus. And people are asking those questions. And now the numbers are available. Who is able to generate alpha? Because today investors have a choice. If you don't give me more than what the market gives me anyway,
I'll go.
What's the point?
Correct.
You don't deserve my money. And anyway, somebody has a distinct guarantee of substantially lower cost when choosing an index fund. You can get India's finest large cap fund in the index format, the passive fund, at 1/15 the cost of a regular plan. That creates a competitive advantage. A fund manager has to beat that by some meaningful margin to look nice. Otherwise, you will look very embarrassing as an active fund manager in 5 years' time. And that is now becoming very clearly visible on my website if somebody is monitoring his portfolio.
I'm going to circle back to that index fund thing because I think TRI was a big differentiator in mutual fund returns when they talked about talking about the index fund and TRI thing. But just to round off this investor related question, do you find you give me some nuances, but I'm just curious to know that do you find any predictable trend or do you find any insight between say male and female investors, between T30 and B30 investors, between investors who consume data while they are accessing index fund versus active funds? Is there any insight that you see that you can share?
I would say the bigger divide is not gender. The bigger divide is geography.
Okay.
The second tier city which has less access, they are more aspirational and they are more venturesome.
Risk appetite is higher.
They are more aspirational. When I look at men versus women, women actually they tend to be, they tend to optimize. They are more disciplined. I have come across ladies. In fact, in Delhi, I get an opportunity. Many bureaucrats retire, and all their life they have never invested. They have no market exposure. They have never invested in an IPO. They have never invested in an NFO, and they are also very lucky. They are going to be taken care of by the taxpayers anyway all their life with the inflation-adjusted pension. So they have every reason to be very happy about it, being assured. And they have earned it. That is how we are configured. I'm not complaining about that. But when you get a sizable accumulation of a lifetime of work on your retirement and you are a Government of India employee, and when I tell them that this is how to do it, invest your money, and they have no income expectation from that. In fact, their healthcare is also taken care of by a central government health scheme. So when I think of a lucky person like that, and when I initiate them to something like an equity portfolio to be gradually built for half their portfolio and half of it being invested in RBI bonds, they really like it because they have the implicit understanding of the safety of half their portfolio, which will never fall. And what about the amazing thing which I have seen after 2-3 years after they have invested is that they come back to me after, if somebody invested 5 years back or 3 years back or at 8 years back, they come back very sad.
They come back very sad.
Very sad.
Okay.
They come back very sad simply because by the methodical way of that money gets deployed in a diversified equity fund, 2 or 3 of them, and low activity, low inactive, great inactivity, not much to be done, low maintenance. And when they see that this money has multiplied so much, if that money doubles in 4 years' time or 5 years' time, they come back very sad that all their life they were deprived of this, and the money that has taken all their life to earn, that much has been created in last 4 years.
4 years.
That has a very profound impact. And this is nothing but people have in this country, because we are a fixed income country, people start their private sector job and their money gets into employee provident fund organization, which is substantially fixed income. Only of late, some money has started going, and I don't know how investors will experience it. Then comes the government employees. They are assured of their pension. Their provident fund money gets into a pool which is their superannuation fund, and that will also get a fixed income. All our life for the last 30-40 years, we have been assured that if you are a nice guy, open your public provident fund account, and there you earn a fixed income, and you are assured of your capital. And that was fine till the market was not democratized, the market was not opened up, the market was not accessible. This is the substantial change. I'm just saying that it was all fine and it was valid till mid-90s.
In a context, it was
Or
valid.
till the 90s. But thereafter, now the initial days of, I don't know whether you were at Birla or at that point, I helped somebody, start his SIP. And he started his SIP with 12 post-dated checks. And in one of the month, around Diwali, he said that, I need the money for Diwali. So will it be a default? The understanding was that, your check will bounce, you will not have that much money, 1,000 rupees to be debited from your account, and, it looked like you are defaulting on your EMI. And the biggest nightmare that happened, or the big revolutionary thing that happened many years thereafter, was that banks were willing to get a signed application form to accept a mandate that this much money can be debited from my account. That looked like a great financial innovation, and that was the first step towards the democratization of SIP, or the beginning of SIP. And today, with 3 clicks, you are able to set up a debit mandate with your UPI account. So I think, if you look at the ecosystem, the way it has evolved, first and foremost, we did not have centralized banking. The biggest thing that happened in the early 90s was that Axis Bank was able to open ATMs, and it was able to build the largest ATM network, almost matching SBI.
UTI Bank at that time, right?
UTI Bank at that time.
Yeah.
And the difference was Axis and SBI was unable to leverage that ATM network because at the back end, the centralized banking was not operational in SBI, despite having the largest network, because it was migrating, it was moving its legacy system from branch banking, which had computers which were not connected to the regional office, which in turn were not connected to the central office. So that took 8-10 years, and that is when Axis Bank started with the revolutionary, or Axis or HDFC or SBI or Punjab and whatever, the Centurion Bank and things like that. Their biggest advantage was that you had centralized banking. You can set up everything. Everything was, in fact, I was at Value Research, I was maintaining my account with a public sector bank. And Axis Bank boss, who used to be a UTI person, he came to visit my office and he said that, who's your banker? I said, here's a public
XYZ
sector bank.
Bank, yeah.
And he said that if you do it at Axis Bank, or UTI Bank at that point, the biggest advantage is that you take a check and you don't have to get drafts made to send to your Bombay office, because locally payable checks which will be honored anywhere. And that was the death of drafts. I don't know if somebody is aware that they go and may get their drafts
Super,
made.
yeah, yeah.
So I'm just thinking that, we have come a long way, and I think it is mutual fund industry is a huge beneficiary of the financial ecosystem revolution.
Since we talked about industry, and fascinating, the reason why I'm so keenly listening in is because you're just taking me down memory lane. There used to be a Global Trust Bank and all of that, if you remember.
Yeah.
And this used to be the USP. Abhi to I think check leaves themselves have become a rarity. Life has come full circle. But if you talk about it from an industry point of view, this is an industry today where people look at it and say, not only can we have our dreams fulfilled, but from the outside, and indeed it is, this industry is the stuff dreams are made of. I mean, कहाँ से आप 86, 87 की बात कर रहे हैं, मास्टर शेयर की बात कर रहे हैं, अब आज क्या सोफिस्टिकेशन आ गया है, आज क्या इनसाइट्स आ गया, आज क्या रेवोल्यूशन आ गया, फॉर अ वैरायटी ऑफ रीजंस. हर चीज जो एक आइकॉनिक हो जाती है, उसका एक अपना नैरेटिव हो जाता है, and then people start believing a lot in that narrative. But again, I just like to have that lens of clinical observations through data. आज जो आप इंडस्ट्री देखते हैं, जो नैरेटिव सुनते हैं, how many of them are still narratives and not centered in reality, and how many of them have actually become things which are going to be propelling the mutual fund industry to the next level of growth. एक थोड़ा सा मैं चाहता हूँ कि आप एक इंसाइट दें कि क्या हो रहा है. बहुत सारे लोग बहुत सारी चीज़ें बोलते हैं, डेटा है, स्टोरी है, आप एसेट एलोकेशन करिए, आप बैफ में डालिए, आप इसमें डालिए, आप उसमें डालिए. आपके हिसाब से क्या नैरेटिव है? व्हाट डज डेटा शो?
डेटा तो यही बता रहा है, बिकॉज बाय नाउ वी हैव सीन दैट लॉट ऑफ कंपनीज स्टार्टेड, लॉट ऑफ ग्लोबल मेजर्स स्टार्टेड, they've fell by the wayside. Some of them have vanished. Some of them have merged with others. We have seen the public sector, the ones which were unable to. In fact, it's quite a lesson that all the public sectors who were willing to change, but they were unable to change. So they got a joint venture partner which facilitated their relatively, their change. So if Canara Robeco survives, it survives because it is no longer Canara Bank.
Interesting.
Likewise, if SBI actually thrives and is a leader, so Amundi was there, and before Amundi, it was the Amundi's is also merged entity.
Yeah, correct.
So when I look at, in fact, I don't know, people have forgotten that Bank of India started a mutual fund in 1990, and it was a major force. And they started with the same thing, the Bank of India Double Square Plus and the Can Star and the Can and SBI Magnum Triple.
Bonanza.
Bonanza. Which got wound up and has restarted. So what you see today.
Interesting.
So anybody who was unwilling to change, what I have understood in these years of mutual fund industry is that funds win by process and investors lose by personality. And if any fund which has been able to institutionalize repeatable decision making, and repeatable decision making just not in fund management, repeatable, investor-centric decision making for its marketing, the way it will launch fund, the way when it will not launch fund. Because people have forgotten that, it is, you make money. This is the only business. It is somewhat like newspapers, where newspapers can get away for a long time. It is the only business where you have to balance the interest of two parents. One is your investor and the other is your shareholder.
But isn't that the case always? The consumer and the shareholder.
But in no other product, the measurability of outcome is this precise.
You have a point.
When I buy a Mercedes car, I get a lot of intangibles and I'm willing to pay a lot of premium for that. In case of mutual fund, I get the results every day. Every evening it gets calculated and gets posted. And my cost and my ability to fan somebody's greed and capitalize on that comes to haunt you. And we have seen most of the mortality not because of bad processes. It is because of these decisions. because asset management is not just asset management, it is about expectations management. If you are not able to, and if you fan unreasonable expectation, if you create product which is trying to benefit from it, and it's very easy. Everybody gets attracted to get rich quick plans, ideas, and that comes to haunt you. In fact, if you look at the Morgan Stanley story, it was complete disaster in terms of expectations management and designing it. Then came also, the alignment of interest. If you get 800 crore, which nobody can take away, then you have a very perverse incentive. Then came, so in this success story of this 20-30 years, and among the first few entrants, which started in February 1994, the Morgan Stanley Mutual Fund, the yellow color application form, and people queued up to buy that. It was the second such, people queued up to invest in a fund. And one single line, first come, first serve basis allotment for the first 300 crore. And they had to allot it to everybody, because first come, first serve thing cannot be established in a closed-end mutual fund and there wasn't a time stamping. So, and that led to all the expectations mismanagement. In these 3 decades, when people have, when you look at these whole industry, 1 lakh crore, 10 lakh crore, 5 lakh crore, world's largest, and short-termism, we talk long-term, think long-term, or we preach long-term. And if we behave short-term, you're done. And we have the obituary of most of the leading global players written, which could be rooted in that. When we have a star fund manager who emerges from nowhere, one is that what is rooted in a star fund manager? It is normally either he is very stupid, or he's such a visionary that he was able to spot something. I will tell you examples of this. He was such a visionary that he was able to spot a trend ahead of all others and became a great believer. And not only it turned out to be, because just being able to, envision something which will work in future is not enough. You also have to be right. It must work out.
Correct.
Otherwise, it'll test your patience. So a star fund manager is a very dangerous thing, because when it's the biggest financial risk for investors, because most financial investors.
So let me just hear this again. You're saying a star fund manager is the biggest risk for the investor.
It's
That's
biggest
a very
risk.
profound statement you're making here.
Absolutely, because he's the biggest risk for the investor, because funds win by process, investors lose by their personality. And the star fund manager is one person who is able to, entice the investor with his personality, with his stardom, by assuming some unusual risk, extraordinary risk, where the risk has not visited him so far. That's one. Second is that, most of these star fund managers, they attract most of the money, generally at the top, which turns out to be an expectations disaster. If you look at the mortality of all the star fund managers in the last 20 years in this country, they just went wrong on being successful with a fund in raising money, not managing it.
Very interesting. So I'm a star fund manager, or I'm a fund manager. I become a star because of my performance. Okay, I've taken
And
some
if you
calls,
don't have a process,
and I don't have a process, and I'm so successful that quote unquote I start believing a little bit too much in myself.
no,
And
investors simply pour
investors
money
simply
into
pour
it
money
with expectation.
because they think कि जो बोलते रहते हैं past investments, past returns को मत देखिए, फिर भी लोग बोलेंगे इसने अच्छा return दिया है तो इसको पैसे दो, which usually happens when the fund peaks out in terms of performance. Very, very interesting. In fact, I wanted to talk to you about this. आपने ये जो peak का बात किया है.
Catching a market peak
हाँ.
is one of the only thing which, because that is the time when investors are in a frame of mind of, I don't have to miss it anymore.
The FOMO
The fear of missing out, is highest at the peak, and catching a market peak is the biggest risk. And if you look at the flows, I have looked at the market flows into mutual fund, flows into companies' IPOs. It normally happens at the peak, and it becomes easy. In fact, when I look at the role of an advisor, forget about asset manager. They are in the business of managing money. If you give them money at any time, they will manage it. But the role of an advisor typically is, he of course, he has to supposed to give you a curated list of investment for your goals, rebalance it, work on an asset allocation. But there are two things which, despite all the AI, everything, no machine will ever be able to do, is that there are times when you say that you are willing to borrow money to invest because you are missing out. And there are occasions when somebody says that this is enough, I just need to quit. I can't take it anymore. When you are madly, wanting to get out of the market, and when you are madly wanting to get into the market, are the times when advisor is needed. Rest of the time is all mundane stuff.
I mean, this is a profound truth which I think people are now realizing.
It takes 5-7 years to appreciate it, to understand the value of it. Because as I said in the classroom, that you have to lose your own money to make sense of it. And if you have to lose money, and if you die in the process, then you don't get the next chance.
But then why do investors go to direct plans so often? Ultimately, you do need to have a financial advisor. And it's apparent in times of extreme stress, right? Then either ways, then why do people flock to direct plans, or why are people flocking to direct plans?
One is that there are not too many advisors, and the second is that distributors are not necessarily advisors. They were also messenger of the same FOMO, and I don't think they have the credibility of facing the investor with their head held high. Because if I drove the investor to buy into that technology fund at the peak, if I was selling the infrastructure, the sixth infrastructure fund to the investor, how will I go and actually tell him not to sell it?
So interesting.
In fact, if you have, and if there are credible distributors, they will have the courage, and actually they will have a follower. And there will be, and I think those people are in minority, because the kind of validation that is required to become a distributor is not good enough to provide you, because this simply takes time. I think a person who is in a position to give good advice will happen only after 10 years. This is a behavioral thing. It is being a psychologist. In fact, the psychological part of it is one of the biggest things. Getting an ARN number and after passing an NIS exam is just not good enough. There will be people who will be good, but they are exception rather than the rule. There is one more thing to it.
Yeah.
Why people are going to the direct plan? It is not any of these. It is not that investors are choosing that there is an advisor and there is a distributor and this and that, or the direct plan. Simply because nobody is interested in entertaining a person with 5,000 rupees to invest. If I want to do a 2,000 rupees SIP, nobody can help me with this. There is absolutely nobody who will help a 2,000 rupee SIP investor, and that is happening in large quantity. If you look at mutual fund industry, which started in 1992 with the opening up, with the start of the open-end mutual fund in 1995, last 5-7 years it has happened. And then we were able to happily attract something like 1.8 crore unique investors. And in last 2 years or 3 years, we have added another 2 crore investors. If this is the growth, I don't think we are just geared to, and if it is to be advised and then attracted, it will not happen. I have another point. If, in fact, they are not advised, and I don't care. If you choose the rotten fund, and if you do your SIP for 3 years, you will end up being a winner anyway.
Oh yeah. Okay.
So what's the problem?
Interesting.
The only thing is, if you forget it, you will become a winner, because it's a diversified portfolio. Direct plan, you have a natural advantage of anywhere between 75 basis point to 1.25 basis point. And if you have just chosen a diverse vehicle, not a narrow vehicle, it will also it will not take you through a wild spin. I think most people are sorted, and anyway, we don't know which one will win. And if you have gone ahead with an index fund, good for you.
Where does active work? Where does it not work? What type of investor are you seeing where it will work? Retail, HNI, institutional? what would be your, I don't want to use the word advice, but what would be your insight in terms of active versus passive funds, in terms of where, what, and what goals should be there? I'm just trying to get, because right now there is a section of people which swears by active because of its propensity to beat the index. Having said that, there are a lot of funds which are not able to beat the index also. So the argument is that why not invest into an index fund or into an ETF, right? So which type of investor is most suitable for when you talk about an active versus passive? Just some insight in terms of what data is throwing up.
One is that active versus passive is not an ideology.
Acha.
It is not an ideology. It is skill versus discipline.
Okay.
And most people only control discipline. You can't manage skill. You don't know who is skilled, who is not, and it takes, you don't know, as Mr. Buffett said that, you don't know who is swimming naked till the tide is over.
Goes out, yeah.
So you don't know what is skill and what is luck. And sometimes this tide can actually be on for many, many years. And there are a lot of external pressures, and we can keep talking about it. And sometimes, likewise for the bad news, we can have a downturn. So my own understanding is that active can add substantial value when the markets are not very efficient.
Which is
when a lot of things are in turmoil. There is a reward for your conviction. There is a reward for being thoughtful. There's a reward for understanding. I meet a promoter, and I'm excited about this stock. I'm not talking of the basic things, because that is now reasonably sorted with the transparency, disclosure.
Yes.
There is hardly a person who will not understand. And there is a reward for being, having the patience and having the foresight. There are fund managers with foresight. They can actually tide through those periods. They can really see that, okay, this is bad, nobody likes it, and I am taking a bet on it for this reason. There are people who will behave like a herd. So active has a role, and passive is becoming increasingly where adding value is going to become very difficult, because active could in itself could become a very dangerous thing. Most of our big index funds are capitalization weighted. If they are capitalization weighted, then, and if there is a default money, now we have the NPS money, which is getting into top 200 stocks, or EPFO money getting into that, or individual investors taking fancy to this index fund and putting money. And the SIP book is rising, of which a small part is going to be index fund, allocated to index fund. Then there is a natural cycle, and that becomes a self-fulfilling prophecy. You have and the stock market was invented for price discovery, for reasonable pricing, for being judgmental about it, for being, and of course, you don't have enough to, so there is a noise as well. Every day market opens at 9:30 to discover the price, and there may not be too much to discover. So that is why we go about inventing reasons to give an excuse for resetting the price. But that's not the point. The point is that too much money chasing these stocks in a methodical way, in a structured manner, can lead to aberration. You can have companies, and the breadth of Indian market may not be good. So I think there is a case for index fund for many people. From an investor's point of view, I have thought about it, that many investors are excited about investing in index fund, and many investors are they buy into the whole idea of they need to invest their money actively. But in both the cases, to profit from it, you need patience, you need discipline. If you move from one index to another, you will just be just as bad. Likewise, if you choose a fund not carefully and you keep moving from one to another, it actually reminds me of a cricket story. There used to be a captain of England, Mr. Nazir Hussain. And people used to praise him for that. Okay, he was very he was very tactical. He used to reset the fielding very intimately, very closely. And basically what he used to do was, if some batsman is playing and he hits a 4 on this position, He used to put a player there.
उधर लगा देता था.
Then he'll return the other side, on the on side or the off side. So he'll keep moving players, and people thought that, okay, he's very tactically agile captain, and investors shouldn't behave like that.
Touche. I think that's a great point. I think this has been a fantastic conversation.
No, I'm just laughing at it that, investors actually behave like this. This has done well, buy it, and then it stopped doing well, then buy another, then buy another. And the next 4 or 6 is there, coming where you don't know. It's all about anticipating and not hindsight.
I personally invest in ETFs, which are thematic. Because कई बार ऐसा होता है कि आपको लगता है कि आपको कोई थीम में घुसना, डिफेंस फॉर एग्जांपल, क्या स्टॉक उठाया जाए पता नहीं चलता. मेरे तो कंप्लायंस रीजंस भी था, आई कुड नेवर पिक अप अ स्टॉक. So ETF is a good way to build up your portfolio, but I think the secret sauce is to hold on, not be tactical and not be a Nasir Hussain. I think point well taken. There was some analysis which I did recently, more of a qualitative analysis, and then I plugged it with some data also, which talked about that each time a crisis happened, आपने हर्षद की बात की, काफी क्राइसिस हुए, 2008 का क्राइसिस हुआ, उसके पहले रेगुलेशन क्या था और उसके बाद क्या क्या रेगुलेशन आए. जब रेगुलेशन, so because you cannot avoid a controversy, you cannot avoid a scam, people are smarter, this fraternity is very smart, but रेगुलेशन आया. रेगुलेशन के आने के बाद मार्केट टेपर ऑफ हो गया, मार्केट फ्लैट आउट प्लेटो हो गया कि मार्केट टुक ऑफ. ईच टाइम रेगुलेशन हैज कम इन, द मार्केट्स हैव टेकन ऑफ. Okay, so my question to you is that most people think that mutual fund industry is very highly regulated and there's very little elbow room. Would you argue with my point, or would you side with my point of view, saying that regulation has actually helped the industry grow? Or would you say that if there was a little bit more nuanced regulation coming in, then the industry could have grown much faster? And allied, yeah.
No, I think, regulations are never exciting. Nobody can say that. Even I remember, early 90s when I visited Bombay for the Mumbai, then Bombay and now Mumbai. I visited Mumbai, and I thought that, compared to Delhi, there was complete lawlessness here.
Really?
Yeah, because nobody used to wear a helmet. And in Delhi, everybody used to wear one.
That was the only lawful thing at that time Delhi did.
Yeah, so in that sense, and when somebody would have enforced कि helmet पहनना है, it's never exciting.
Correct.
People saying, it's itchy, it's sweating and this and that. But it makes them survivable. आपका सिर है बचाइए.
बिल्कुल सही बात है.
So that is what regulations do.
Very
now,
interesting.
In case of mutual fund, regulations have been fairly anticipatory in the last 3-4 years, 5 years. I would say that in fact, the whole industry I would say that, investors should thank the regulator that it has anticipated. In fact, think of it. Today, if mutual fund industry and the distribution force is not focused on cost, then the mutual fund experience can be had from a small case. From small case.
Small case. Yeah.
Where the underlying transaction cost, the company, the largest broker in the country is called Zerodha.
Yeah.
Zero cost. So one should be fearful of this. My job is to getting a portfolio of stocks in an actionable fashion, which will hold for a very long time with very less periodic intervention. And that could be a threat. Today, most investors actually start building a good diversified portfolio where they are not under some of those institutional pressures to be consistently looking nice and good. Mutual funds today can't do many things because of their scale. Most of the flexi cap funds actually become large cap fund. And most of them say that we are there by choice. But I know that they are not there by choice. They don't have a choice but to be large cap. But I would say that, making it survivable is the goal of regulator. Regulation is never exciting. Third is that, regulations have all the praise for it being anticipatory. And when I look at some of the operational trivial things, I think, Indian regulators are, SEBI has been particularly, not because, I'm part of it, I think they're very, they're willing to listen to a few things. You remember one thing used to happen before? I wanted to invest for my driver. and without telling him I can write 12 checks and set up his SIP account, only get his form filled. It was possible, third-party checks.
Third-party checks, yes.
Then what happened was some distributors used to take some third-party checks, not third-party checks, customers' application form and check, tear his application form, put his own application form,
और
and
check डाल देते.
redeem, invest the money, redeem the money, go back home.
Correct. वो हुआ है.
This kind of fraud started happening.
Correct.
SEBI made one simple rule. Money from an investor can come from his account and get invested. Only investment will be made from the person who is writing the check. And the investment proceeds will go back
to the same account.
To the same account.
Correct.
That has eliminated the possibility. Now this will cause problem. It created problem for me. I had started investing for 6 people whom I wanted to invest, but I did not, but they did not have the bank account. And opening a bank account before the Jan Dhan account started happening was a nightmare. In fact, even subsequently, KYC for them at a place where the mail will not reach them is a problem. I don't know how, if somebody lives in this airport vicinity, and if somebody has to get his letter for his KYC, how will he be getting it? No, so, regulations, they look, most of the time, regulation, in 3 cases, regulations happen. One is that the regulator, in fact, the anticipatory regulation is the nicest one. When the regulations have to intervene. You remember 2008 and we had the FMP crisis. Very recently, we had the Franklin crisis, and something had to be done there. Or and if you look at the long-term actions taken, now there is a likelihood that the Franklin kind of crisis may not happen, simply because now we have a large fallback fund funded by mutual fund industry, managed by as a AIF by SBI Mutual Fund, which can get activated if the market is getting into a state of freeze in the fixed income market. That I think is a great creation. In fact, in the fact that we have this will ensure that we will not have that crisis. That itself preempts the crisis rather than ensuring that we will have something to fall back on. Second is that if you look at the FMP crisis, most of the crisis has been created by the industry. If you look at, one day, I remember because I have been in a limited way, part of the conversation or part of the action which was taken. First was the entry load abolition. Looked like the industry is coming to an end. And after that, the industry became, more agile, more flexible, more transparent. Second is that it actually curbed all the sharp practices of selling. And it was just resolving a conflict. We have to resolve the conflict. If we are humans, we are guided by the incentives. If we get rewarded for slapping someone, we will just find excuse to slap. Likewise, if the number was very much visible in the churn and entry load was trying to do that, everybody found ways and means and excuses to do that. Look at the mutual fund sector classification. If you look at the classification, and many a time SEBI is unable to anticipate that what will be the unintended consequence of this, what will be the way, how the industry will find a hacks to, for this law. Let me, when the entry load was abolished, the hack was that, it is going to be very injurious for us. So do it, but don't do it for closed-end fund. And then we had suddenly the emergence of closed-end fund all over again. And so that happened. This proliferation of similar funds of same kind coming in different packaging while people were creating the, different fund, same fund but in different name. So there was a law framed, value research classification system was nearly taken as a classification system. For peer comparison was taken as the fund classification system, and said that you can have no more than one fund in each category. Now everybody started inventing an index and launching one. And in the last 2 years, ever since the start of the, that classification system, we have had something like 700 new funds being launched. And that left a window. We left a window for that this thing will not apply to index fund. This fund will not apply to thematic fund, because you can have any kind of thematic. So that is why we have this proliferation of this thematic fund and the index fund. And index funds, people are happily creating index funds for some goddamn concept, which we had never heard of. And they're proudly claiming that we invented this fund at the request of the fund company which wanted to launch one. So this, the product department has shifted to the index company to a substantial extent. And many of these things are happening. So I think, and I don't think there is I don't know what is the solution for this. We sometimes, regulations are made to fix a symptom. I think all that we should let it happen. Let people launch one over a period of time. But, I think investors should be told with, anything which is not mainstream. Just state it loudly that this is a narrow fund. This is this. You can lose money. Give a longer, back to, history, validation of that strategy. Things like that. Because I think we have to start appreciating that investors are intelligent. Many investors. And maybe if we are somehow, move our law to in such an extent, because today we have that technological wherewithal, that these are the investments. You can create any kind of fund of anything that you want. But any new investor who has not been investing for 3 years, that is the start of his first folio, is not eligible to invest in any of these exotic things.
It's sort of maybe accredited status.
Not accredited, just basic life.
It's right.
3 years, because
I think it's a great point.
Investors evolve with their experiences.
So you're saying that unless you've been in the industry, you've been invested in a fund for 3 years, don't get into something which is thematic or whatever.
Anything. Anything sectoral, thematic, narrow, because that is not the design of mutual fund. Mutual funds were supposed to diversify our risk.
Excellent point. Very good point. And while you were talking about all these funds, I was just cringing because I've launched quite a few of these funds, which you reminded me time and again. But I think this last insight has been very fabulous, and I hope it gets picked up. That you have to stick to simple investing before you start thinking about a few more ambitious forays into investing. I think it's a very good point.
People miss out on one thing. There's regulatory changes. The mutual fund industry, they are measured by AUM, they are measured by innovation, they are measured by number of investors, or how many accidents they had in their life and all that. One should not forget that this is a practice, this is a profession, this is not a asset, this is not a capital-based business. It is somebody else's money. It is being invested elsewhere. You are keeping an oversight.
Yeah.
You have to be reasonable. And your primary capital is trust.
Correct.
And that has to be earned. And regulators are there to make sure that you have the guardrails.
I think this has been a fascinating discussion, and I quite like the way you talked about the role of regulation. I think more information dissemination, controlled sort of an environment where there are guardrails, it actually applies to a lot of things in life, not just investments. I quite like what you're saying. We've got students here who are very keen to get your insights into a lot of things, and maybe you could also supplement it with some stories on how you have personally gone through them, some life hacks, if you will. So I think we should just have the students ask some questions. Yeah.
Good afternoon, sir. My name is Soham Nair, and my question is, what major changes have you seen in the Indian mutual fund industry over the last 5 years?
The biggest change is, investor behavior. Investor can decide and he can start investing in 15 minutes, and he can do it himself. And that has led to a very emergence of different kind of investor. And the other is that all the investors who have come in the last 5 years, many of them are able to do SIP. So they are unlikely to be hurt or injured by whatever happens to the market. I'm little apprehensive that how will they behave, how will they react if the market falls very sharply, because nobody has experienced a downturn. But as more and more people are beginning to do their SIP, even a big downturn will not disappoint them. Investors' reaction to capital loss is very different from when they lose a part of their gains. Your 10 rupee becomes 20 rupees, and then it comes down to 14 rupees. You will not lose your sleep. But if you invest 20 rupees and it becomes 15 rupees, then you have a problem.
A question that I wanted to ask you was looking back at your own journey of research, value research. What is that one leadership quality of or lesson that you think if you had earlier, it would have helped you in your journey through in your journey?
If I had the foresight of devising, I have been a very hands-on person. And it took me many years and I'm still not completely overcome that. I'm still hands-on. But I'm now, for a few years, I've been able to build some processes and all. So where I'm able to delegate effectively with embedded confidence that it will be run the way I would like it to be. So building processes, I think, is the key leadership responsibility. And that could also mean building an editorial process whereby people look at things critically, imaginatively, thoughtfully. That is also one of the process. Most of the other process, we think that it is a very mechanical thing, do this, do that, or creating a task list, who is responsible and all that. No, but a thinking process, what we will do, what we will never do, and how to look at things, and why we should be looking at things and not any other way is very much part of it.
Sir, my question is, in this current market environment where volatility, global cues and valuations are all in play, what should long-term mutual fund investor focus? Whether it should focus on asset allocation or market timing?
This is nothing new. This volatility, markets fluctuate every day. And because of variety of reasons, and that has now gotten compounded by social media, the kind of impact it has, the kind of information that you have access to today. It was accessible only by institutional investors 10 years back or 20 years back. So everybody now has greater access to all that. We are more connected. You can buy some gold, some silver, some oil, wherever. So markets are accessible. So I don't think this is anything new. In fact, it will only compound many a times. But I think noise is not only going to get magnified, accelerate. The only thing which, in fact, this is one thing which one should look at as an opportunity. Your discipline can make a hell of a difference, and you can beat all the opportunists by a wide margin simply by your discipline.
Sir, considering the global uncertainty as well as the fake narrative which is being set, how would you like to narrate that the statement of mutual fund sahi hai will hold strong? Because yesterday itself in the evening I came across a news that Nirmala Sitharaman ma'am has suggested to invest in the mutual funds on the 14th of February, Valentine's Day, then mutual relationship. Whereas in the morning it came out to be a fake news.
You should not invest based on fake news, but you don't know it is fake or not. One is that isolate yourself from noise. Just look at it, we earn every month. We should build some basic foundation as soon as we start earning, some emergency fund, so that you don't have to depend on somebody if there is a small emergency. Then you should not be investing your short-term money. The money that you have to give to your dad for your sister's wedding should not be invested in equity if it is happening in 1 year's time, 2 years' time. So understand your own thing. And so the urgent things should never be invested in equity. And then you should start investing your long-term money, the money that you don't need in the foreseeable future. The first principle of doing it is diversify. If you can't choose a stock on your own for the merits, because investing stock on your own is a very difficult thing. It is, for most new investors, it is speculation, not investment. Because unless you understand that you have what is the standard process of looking at of investing in a stock, you evaluate options, then you look at companies and you think that okay, this is a company which will do exceedingly well. But what will you do about the 5,000 other companies which will not do exceedingly well? It's a relative story. Till you do that, start with a mutual fund. And if you are a mutual fund investor and starting out, start with a flexi cap fund and nothing else, simply because it is you invest in mutual fund for the primary benefit that you can diversify. And because we don't know, in fact, the noise is making the market even more volatile. Making it more volatile, so you will profit from, even if you have 50,000 rupees to invest it over next 5 months, because you will profit from the fall and decline. Initial periods, it is extremely important to diversify, spread your money, because the moment you catch a market high, assuming that you would have invested your money on 1st of January 2026, माँ ने 50,000 रुपया दिया कि जाओ बेटे खर्च invest करो. So what I'm saying is that the impact on your mind for catching a market high is very high. That is why, and because you have to do it for a lifetime, it is important that you build confidence in it. The way to build confidence is invest in equity, diversify your money, which means not invest in any narrow fund. But what will happen is that you will get out of this road and you'll come across this hoarding that invest in this e-com fund, invest in this electric fund, and you will say कि हाँ, this is an opportunity. पूरा two-wheeler industry electric हो रहा है, और जब उसमें लगाएंगे तो you are compromising on the basic thing that you were investing in equity to diversify, to reduce your risk and participate in the overall growth. If you do these 2-3 things for 2-3 years, these 2 things, equity for the long run, do your SIP, keep it broad. End of the story. Nothing else needed.
From taking 3 weeks to opening an SIP account to opening an account within 3 seconds on an impulse. From master share to mastering the art of disciplined investing. From star fund managers to process-based investing. This has been a wonderful discussion, a masterclass. And I would actually add that it's not just a masterclass, it's a walk down memory lane. A lot of nostalgia, a lot of humor, but more importantly, insights backed by data. That has been the fulcrum of today's show. I enjoyed that thoroughly, and I hope you enjoyed that as well. Thank you so much, Dhirendra, for coming in here. It's been a wonderful, wonderful experience. Thank you so much.